Hello, my name is Doug Pless. I'm a full-time trader and a SpotGamma content contributor. This presentation is a case study that shows how to use a variety of SpotGamma tools to find and plan a trade in the SP 500 index. For this trade, my instrument was SPX options, and the duration of the trade was intraday. Here's the agenda for this presentation. First, I'll go over a brief overview of the SP 500 index, SPX. Next, I'll cover my planning process, how I use SpotGamma tools to analyze an instrument, and how I develop a thesis. Then I'll discuss trade execution for the case study. Finally, I'll review the key takeaways for this case study. The S&P 500 Index, or SPX, is a market cap-weighted stock market index that tracks the performance of 500 of the largest publicly traded companies in the United States. SPX options trade on the CBOE. They are cash-settled and European style, meaning they have no early assignment risk and no risk of being assigned physical shares. SPX has options that trade every trading day. These zero TD options are key drivers of price. Finally, SPX options are very liquid and trade at heavy volume. For pre-trade planning, I look at the following data. I'll look at the SpotGamma key daily levels and how they change from day to day. Also look at trace heat maps. I start with gamma around the open to see how market makers are positioned. I watch the HIRO indicator to identify directional pressure from options flows. Finally, I use the options calculator to analyze and refine option strategies. Before moving on to the case study, let's briefly look at some background information and explanations of these levels and charts used in the case study. The key daily levels are available on the dashboard home screen, and the data table at the bottom of the Founders Notes, and an equity hub. They are updated every day and are proprietary to SpotGamma. The absolute gamma strike is the strike where largest absolute positive negative gamma. The volatility trigger is SpotGamma's proprietary gamma flip level, with positive gamma above and negative gamma below. In a positive gamma environment, market makers have to trade against price to hedge their delta exposure. This tends to subdue or decrease volatility. In a negative gamma environment, market makers have to trade with price to hedge their delta exposure. This tends to enhance or increase volatility. The call wall is a strike where largest net positive gamma. It can act as resistance, since market makers will most likely have to increase delta hedging at this level. The put wall is a strike where large net negative gamma. It can act as support. For this trade, I used the Trace Gamma heat map. It is also proprietary to SpotGamma and it updated every minute. On the right side of the chart, the Trace Gamma heat map shows areas of positive and negative market maker gamma for SPX. Blue zones indicate positive market maker gamma. Red zones indicate negative gamma. Darker colors indicate stronger gamma. Traders should expect lower volatility and positive gamma, that's the blue zones, and higher volatility and negative gamma, the red zones. On the left side of the chart, the strike plot reveals the real-time options positioning across SPX strikes for gamma exposure, GEX, open interest, OI, and net open interest, net OI. The SpotGamma HIRO indicator shows the market maker hedging impact of options trades. It is also proprietary to SpotGamma and is updated in real time. Market maker hedging flow can have a significant impact on price. This chart shows calls and puts separately for a combined signal of all 500 stocks in the SP 500 index. The candlesticks show price for SPX, the orange line shows calls, the blue line shows puts. A falling orange line indicates traders are selling calls. A falling blue line indicates traders are buying puts, and vice versa. SpotGamma's options calculator empowers traders to model the profit and loss for a trade by pairing real-time options data with a powerful interface. Some of the key features of the options calculator include personalization. You can customize your layout and save trade templates. Volatility metrics. You can adjust applied volatility and skew across expirations, and SpotGamma levels. You can show SpotGamma's proprietary support and resistance levels. Let's move on to the case study. Here's my thesis for this trade. My directional bias was bearish. SPX was currently on a downtrend after reaching intraday high of 7620.9 on June 2nd. I was looking for a continuation of the move lower during this correction. I also expected lower to moderate volatility and mean-reverting price action due to the positive gamma shown on the Trace Gamma heat map at 9:30 a.m. Eastern Time. Let's take a closer look at the basis for my thesis. This is a daily chart of SPX on June 21st. SPX had rallied from an intraday low of 6316.91 on March 30th to an intraday high of 7620.9 on June 2nd. SPX began to trade lower the following day and continued to make lower highs. On Tuesday, June 9th, shown with a small down arrow on the chart, I expected SPX to continue to move lower. This is the trace gamma heat map at 9:30 a.m. Eastern Time on June 9th. It shows SPX was trading in a positive gamma at the open. This indicated market makers would most likely be trading against price, leading to lower to moderate volatility and mean reverting price action. Here's my plan. On June 9th, SPX opened at 7438.66, below the 7470 volatility trigger. I plan to watch how price reacted if SPX rallied up to this key level. Also plan to watch HIRO to see if traders are buying or selling calls and puts, and if market makers were buying or selling futures and stocks. If SPX moved up to 7470 and traders started buying puts and or selling calls, I plan to look for a short setup. After the open, SPX rallied up to and above the 7470 volatility trigger to a high of 7483.15 in the first 20 minutes. At the same time, options traders were not supporting the move higher. They were selling S&P 500 equity calls and buying puts, shown by the flat to slightly descending orange and blue lines respectively on the HIRO chart. As SPX traded above 7470, traders began to aggressively sell calls and buy puts, shown by labels 2A and 2B respectively on the HIRO chart. When traders buy puts and sell calls, market makers take the opposite side of the trades and sell puts and buy calls. Since market makers want to remain delta neutral, they had to sell ES futures and S&P 500 equities to hedge their delta exposure. A few minutes later, a HIRO flow alert signaled significant options activity and confirmed the move lower. The alert is shown with label 3. The trace gamma heat map at 10 a.m. also shows that HIRO reversed sharply lower around 9:50 a.m. as SPX found resistance at the 7470 volatility trigger. It looked like the mean reverting thesis was playing out. The volatility trigger can often act as support or resistance. In a positive gamma regime, I expected the volatility trigger to act as resistance when tested from below. I plan to sell an SPX call spread if SPX moved up to or above the 7470 volatility trigger. As SPX traded up to 7483 and began to reverse lower, I sold an at-the-money 7475, 7480 call spread for $2.65 credit. The options calculator shows the short call spread for one contract at expiration. Here are the trade results. Again, I sold an at-the-money 7475, 7480 call spread for $2.65 credit. The risk for the trade was $2.35. If SPX closed below 7475, the trade would be fully profitable. As it turns out, SPX traded down to an intraday low of 7237.85 and closed at 7386.65, well below the short strike of the call spread. There was no need to take further action, so the trade expired for full profit. The reward to risk for the trade was a little over 1-to-1. Here are the key takeaways for this case study. First, positive gamma on the trace gamma heat map indicated lower volatility at the open and the potential for mean reverting price action. Next, the SPX 7470 volatility trigger acted as resistance as expected. Finally, HIRO provided a clear signal that traders were buying S&P 500 equity puts and selling calls, and market makers were selling ES futures and stocks to hedge their delta exposure. That wraps up this case study. Thank you for watching.